Hello. Today we are going to work on a bank reconciliation problem. This is from chapter 4 and this is our homework problem. So let's take a look at what we have in the textbook. I'm using the textbook, the problem that's given in the textbook. You will have different set of numbers, but essentially the same problem. So let's get started with looking at what we have over here. We have DS Company. On May 31st, they're looking at their bank account. They say they have $5,100. But the bank statement, I've just kind of cropped off the top part. The bank statement says that we have $6,210. Well, it's kind of nice that we have more money there. However, we need to make sure that we reconcile these two amounts. So I'll walk you through both of these, the tables that are presented over here, the excerpts. This is the cash account. So this is basically your records from your general journal. And this is the bank statement you got at the end of the month. So our objective is to prepare a bank reconciliation statement, and we'll see how to take care of that. And after you do the bank reconciliation statement, you'll have to do adjusting journal entries. Again, I'll show you how to take care of that. So let's take a close look at what we have here. So this is from our general journal. This is only the cash account for the month of May. I started the month of May with $5,280. I ended with $5,100. The bank says I started with $6,260 and I ended with $6,210. So we are trying to reconcile the 5,100 with the 6,210. And we'll take a look at how we're going to do that. So here we have all the receipts for the month. As soon as we collected cash, we got cash, we put it in the bank. These are the dates that we have here. They're saying that they were all sales. These are the dollar amounts. These are cash receipts, which means cash is debited, cash increases. And we had cash disbursements. Now, all our cash disbursements were by check. So we have checks number 471, 72, 73, 4, 5, 6. We have all these checks written out. Now let's look at what the bank says we have over here. The bank says these are all the deposits that were made. And these are all the checks that were written out, or there were other amounts taken out from our account, other withdrawals, and we'll try and reconcile this. So here's my suggestion how I would work through with this. I'm going to show you how I'd work through this over here real quickly. I start with the cash receipts. I look to see if the amount I have over here is the same that I have over here. What you'll notice is the dates are not going to coincide. So for instance, on May 3rd, I had sales of $1,460. On May 4th, I have a deposit of $1,460. So I may have deposited the money at the end of the day. The bank is reflecting that on the next day, and that's fine. So these two numbers are there, so I'm just going to strike them out. I don't need to worry about it. The next deposit was $1,890. And the reason I struck that out is I see that over here as well. Next deposit is $2,520. I see the 2520, so I'm taking it off from both places. I don't need it. My next deposit was $2,990. And if you go down, yeah, I did find that $2,990. And in case you're not sure, look at the date. This is May 25th. This was May 24th. So yep, that's the right one. So we got that, okay? Now this deposit I made on May 31st. It's not showing on May 31st on the statement. So probably the next day it's going to show up. So I'll take care of that. Similarly, over here, I have some things over here which have not been taken care of, and I need to worry about those. So I'm going to highlight this because I need to come back and look at it. So these are the amounts that I will have to reconcile. Okay, let me go back now here to the monies that I said I have paid. Again, hopefully I'll find a lot in common so I don't have to worry about it. Here, an easy way to do it is look at the check numbers. I have 471 through 476, but you should also pay close attention to the dollar amounts because sometimes the check may have cleared, but for a different amount and somewhere there's a mistake. So let's start out. I have checks 469 and 470. I didn't write those out in May. So let's look at that a little later. I have 71, 72, 73, 74. So I have 4 checks that I wrote out in the current month. They have cleared. So let's quickly look and see if the amounts are the same. 471, 1300, 471, 1300. So we're good with that. Next one is 472, 1670. And this is 472, 1670. Once again, we are good with this. 473 cleared for 3600. And that was in fact 3600. 473 is the 3600. Yes, here and here I need to take it off. Got confused a little there for a second. And then let's go down to 474, 1500 and 474, 1500. Once again, all the ones where you see the red line, it means they're the same in both places. Not to worry, we can move on as far as those are concerned. Now, these last two checks that I wrote, they have not cleared the bank. So that will be something I need to pay attention to when I do the bank reconciliation statement. Now we have these two checks over here, and we need to see why those checks cleared now when I didn't write it in the current month, in the month of May. Now I have this NSF, that's definitely not good news. We have an EFT and an SF. So let's quickly go over these items. So these two were written at the end of the month. They've not yet cleared. So that's going to clear next month. So I'm not going to be too concerned about it right now. I do need to reconcile it, but I'm not worried about it. I need to investigate these two checks, where they came from. NSF, non-sufficient funds. So this means there was a customer that made a payment to me for $400. When I deposited the money in the bank said, and I did my journal entry, cash debit, accounts receivable, credit, because I got the check and I deposited in the bank. The bank has now said that this customer didn't have the money, so they're taking the money out of my account. So I need to bring that back into my books as an accounts receivable. EFT means electronic funds transfer. So this means I told the bank that they should pay $600 to someone. So most common thing is if you have a card loan, you set it up for auto payment. So they've taken out $600 from my account. So car loan was just an example, but EFT means electronic funds payment. Some payment was made electronically from my account. I need to check what that is because I don't show that I made a payment over here. Finally, I have SF, that's service fees. This is something that the bank charged me. It could be for maintaining a minimum balance, not maintaining the minimum balance. It could be because I ordered checks, any number of reasons. Whenever they charge me a fee, they take that out of my account immediately. Now I need to update my books to indicate that that's an expense in my books. Okay, so these are the items I need to reconcile. I have 1, 2, 3 over here. I have 1, 2, 3, 4, 5, 6, and there's the 7, 8. So there seems to be a whole bunch of items to reconcile. Okay, now before I go any further, I'm going to look at this number and this number. This is balance as per bank. This is balance as per our books. Now, before I go ahead and start working on my bank reconciliation, let's look at that additional information that was presented to me. So I will go down now. Let me scroll down a little and see what they've told me. Two additional pieces of information. The first one is the difference in the beginning balance of the company's records and the bank statement relate to checks 469 and 470 that were outstanding as of April 30th, 2021. That's what those were. So I had written those checks out last month. So those are good too. Okay, so I am going to take those off. I don't need to worry about them. Then they tell me that the bank made the electronic funds transfer on May 20th in error. This is very important. The bank made a mistake. In the past, I would have said banks rarely make mistakes. However, these days, it's not uncommon where banks make mistakes, and you need to be vigilant and check for that. And that's exactly what happened. The bank accidentally charged us for the payment that should have been made on another account. So someone else was making that electronic funds transfer of 600, but they took it out of my account, which means they need to add it back to my account. So I definitely need to worry about this. Okay. Now that I have this taken care of, let me create my bank reconciliation statement. So a bank reconciliation statement is a formal accounting document that is created by a company. This is done on a monthly basis. At the end of every month, a company will do bank reconciliation because I want to prepare my financials at the end of every month and I need to make sure I have the correct amount. So here's how I would do this. Although this is an internal document, this is one of the documents that the auditors are always going to ask you for. So you want to do it in the most formal fashion. And also for internal control purposes, I need to know what this document is. First line, write the name of the company. Second line, you'll write it's a bank reconciliation statement. And now this one is important. I will say this is on May 31st, 2021. So at the end of every month, I'll have a bank reconciliation statement. Okay, so I have two sides. What the bank says I have and what I say I have. Okay, so let's start out with, for my general ledger, I have $5,100. So I bring that number in first. For the bank statement, I'll move this over here a little, or maybe not, I'll better off moving this. I have $6,210. So that's the number I need to bring here. So the bank says I have $6,210. Okay. Now this number, cash receipts, I have already put it in my account. I've already done cash debit. The bank will do it next month. It'll come into my account. So what I refer to that as deposits in transit. In transit means it's still not happened. It's not hit my books in the bank. It should soon. So I put that amount there. That's the 3180. Okay. Next, I look at these numbers over here. These two checks, I've already written out and I've made payments. One is for supplies. So I made a payment. I went to, let's say, Staples. I bought something and I gave them a check of $550. It's going to clear the bank next month. When it clears the bank, it's going to be taken out of my account. Same thing, salaries. I paid my employees. They're going to deposit it. Next month, it's going to go out of my account. So I combine those two numbers and I call that checks outstanding. So these two checks, I add up the numbers, 550 and 3,600, giving me 4,150. I've added the two numbers and put that over there. Checks outstanding. Okay. So at this point of time, let me go back to my, let me change color over here so we can see this. Okay. I have taken care of this. I've taken care of the three items I had over here. Okay. So I'm done as far as this is concerned. Information from my cash account. Now let me move over and look at what I have as far as the bank statement is concerned. Okay, these two numbers, again, since I had the yellow, I'm going to say we identified they are from last month, so we've taken care of those. Let's start with the positive stuff, as in the bank has collected $1,100 in notes receivable. So when money was due to us, that money was collected. We got interest of $60, and this is also interest of $60. And just in case you're wondering how I know what those acronyms stand for, you will see it's here at the bottom, interest earned. INT is interest earned, and note is note collected. So they collected a note for me, so cash increased. They collected $90 in interest, so that is also cash increasing for us over here. So now this is on my side. The bank has already done it. I need to take care of it over here. So I come in over here and I will write add note collected. That amount was 1,100. Interest collected or interest earned, and that would be $90. Okay, so we have now taken care of these three numbers. Okay, let me go back to my drawing here. So I've taken care of these numbers. So these three have been taken care of. Now let me move over here. Obviously, these were additions, which means these are going to be subtractions. They're withdrawals. I need to take the money out of my account. NSF checks, $400. EFT, it's a bank error, so I don't make the adjustment. Service fee is from my side, $40. So let's see how I'll take care of that over here. Again, let me go back here. I'm going to write less. Accounts receivable. Okay, so that number is $400. Service fees, that's $50. Okay, so we're taking care of those two. Now that error that was made, that one, the bank made the error. So I need to put that over here on the bank side. And that amount is going to be added to my account. That amount will be added to my account. Okay, so assuming I've done everything correctly and not made any mistakes as far as signs are concerned, when you add up the two columns, you should get exactly the same number, and that is the correct cash balance. So let me go ahead and add those numbers up and see if I have done this correctly. Nope. See, it was less checks outstanding. I should put this as a minus. Yep, and I do have the correct number on both sides. So this is the correct cash balance. Okay, so in my books, in my general ledger, I said I have 5,100. That's a number I have over here, but it should be 5,840. The only way I can change that is by doing a journal entry. So we will now do a journal entry. We will do a journal entry only for information that's on this side. Only for all the information you see on this side, we will do a journal entry. And when we do that journal entry, our T account or the cash account will change from 5,100 to 5,840. So what do we need to do over here? Where you see the word add, cash has to be debited. Cash will be debited. Notes receivable, which was in our book saying that someone owed me money, I got that money now. Okay, so how much did I get? I got 1,100. I got 1,100. Interest was collected. That interest is interest revenue. A total of $90 was collected for me. And so I will debit cash for a total of $1,190. So that takes care of this first part. Perhaps I will just change the color here a little so I can tell you where this information is going over here. So where I said add, that's cash debit, and those relevant account names have to be credited. Now here I said less, which means cash will be credited. Why am I crediting cash? Because I'm bringing this accounts receivable back in my books. The one I thought was gone, as in I was paid. Well, it's not, so I need to bring the receivables back in my book. And then I have that expense, service fees expense. Those numbers were 450, adding up to $450. Okay, so now if you see what happens, I'm going to quickly do this over here. I had 5,100 as a beginning cash balance. I added cash debit. I added this number and I subtracted this number. So in my T account, cash was debit. I debited 1,190. I credited 450. That's what happened in the journal entry. And let's see what our final balance is. And that's going to be the balance in your updated cash account, which is the correct balance. That's what we need to have in our financial statements. Once again, what I'd like to do is I'd like to make sure I took care of everything I did because it balanced. However, I'm going to look at this one more time. And yes, in fact, I did take care of everything. I took care of this NSF check. I took care of the EFT and the service fees. I've taken care of everything and I'm done with my bank reconciliation statement and the adjusting entries. These are called adjusting entries. The adjusting entries at the end of the month to reflect the true cash balance in my balance sheet on May 31st. Again, you'll all see different numbers on your homework on Connect, but essentially the idea is the same in terms of how we proceed with this. This is probably one of the most important internal control mechanisms that we have to manage cash. And if you cannot manage cash, well, we shouldn't be in accounting, and we probably shouldn't be in business. But think about yourself as an individual. What are you going to do? You need to manage your cash as well. So this is really important that you look at what you think you not think, but what you say you have, all the transactions that have happened, and compare that with the bank on a monthly basis. All firms are required to do it. It's not a choice for them.